What would happen if somebody came into the office and said, "Hey, what should I do with this $1 million? How should I invest it?" Well, we're going to break down a recent article that actually got some opinions from three different financial professionals. But more importantly, we're going to ask Ryan what he would advise his clients to do in this situation. Welcome into Perfect Game Retirement. Glad to have you on our channel once again. I'm Ben Jordan with Ryan Ledden at Black Oak Asset Management, and I like this. This is kind of a fun conversation, Ryan. I think we all, would say, "Hey, what will we do with $1 million?" Well, we're going to kind of try to work through that today.
Yeah, that's kind of the proverbial number. I don't know, that number may be higher for some people, but this is happening. I mean, this is a real thing for a lot of people too. They're coming to retirement and they have a lump sum in a 401k, or recently connected with someone who sold their business and they came into a lump sum. So this is a real thing. It's not just kind of a genie in a bottle, but I get the article. It's a good article. It's interesting, but what would people do with $1 million if it was either boom plopped in your lap, or hey, maybe it's a lifetime of savings? What would you do with it?
Yeah, and if you have questions for Ryan, you can always get in touch. All the contact information is in the show description down below. But speakwithryan.com is the easiest way to get on his calendar. But I think as we go through this, Ryan, obviously we're going to talk about some of the suggestions in the article, which we'll drop in the show notes down below. So check it out for yourself if you want to read it. We're also going to add an important layer to it, right? Is age, right? What should you be doing depending on age? Because the question is going to differ depending on if you're 30 versus if you're 65, right?
Yeah, absolutely. I mean, we've probably heard that for a long time, that age is a big determinant of how you do invest this money. And it is to some degree. I think it's just one piece of the puzzle, but it is a big factor when you're looking at these things, and longevity, and what other assets do you have? What other income streams do you have coming in? So it's definitely a factor for sure.
All right, so let's first start with what the prompt was to get the responses from these financial professionals. So they were asked, how would you advise a hypothetical investor who is in his or her late 40s, who owns a home, has $300,000 in a retirement account, and $300,000 in other assets, and $1 million in cash to deploy in today's market? So very, very specific scenario, but I guess,
Mm-hmm.
probably a little above average, but probably about where you see a lot of clients that come in.
Mm-hmm.
So here's what the pros said. And again, this is going to be in the link below. And so I'm going to go one by one here, Ryan. Just tell me what you kind of think of this. You don't have to get too deep into what they say, but I'm curious on kind of what you think of these approaches. So first one is from Stephanie Link of Hightower. She says diversification, 60 to 70% equities, 20 to 30% bonds / private equity, cyclical sectors, and dollar cost averaging. So it seems like a pretty, I guess, straightforward approach there.
Yeah, I don't disagree with it in general. I do think, I mean, there was a couple buzzwords that Stephanie said in there. Diversification, yeah, you want to do that for sure. Cyclical sectors, yeah, I get it. I mean, I'm not huge on that, but I get what we're going there. And then dollar cost averaging, I'm a pretty big fan of that. However, again, here's where age does determine quite a bit. In your late 40s, which that's what I am as the recording of this. I'm in my late 40s. I'm 47. So what would I do if it lump sum of $1 million in cash? I'm not risk adverse. So I would probably just go ahead and invest that money, because I think of not only just my working life, but my life in general, which again, we're not guaranteed tomorrow. However, I'm hoping that I'm around for a long period of time. So this $1 million is need to last, for another 50 years, maybe even longer. Who knows? So I like the dollar cost average concept there. And again, if we're not familiar with dollar cost averaging, that means just put a little bit of this money, this $1 million, to work over a certain period of time. I wouldn't draw it out too long, but I'm a big advocate for that, especially people who are older. Because are we at some all-time highs right now in the market? Yeah. Are we at all-time highs forever? I hope not. That means, let's put that money to work as quickly as possible. But I get, if you want to ease into it, maybe over the next 6 months to a year, I have no problem with that. The younger you are, the less I would draw that out. The older you are, maybe you want to draw that out a little bit more. But I like what Stephanie says. So I'm in agreement with that.
All right, it's a little more of a traditional approach. What about this one
Mhm.
from James Thorne of Wellington Altus? This one a little bit more aggressive, but hey, in the market we're in today, maybe it fits. Innovation, AI heavy, Nasdaq, S&P, China ETF, 10% gold and Bitcoin, and energy and financials. What do you think about that one?
I mean, it's different strokes for different folks. Again, we don't know who we're sitting across of. I know you gave a pretty good hypothetical as far as age and other assets, but that to me seems that's probably a pretty risky portfolio. Again, if your risk tolerance is there, especially when you're talking about innovation and AI heavy. I mean, obviously AI is not going anywhere, but it's kind of like crypto, and it's a little bit of the wild west. Who's going to be left standing after this, and it may only be a huge few. Who knows? We don't know where this is going to end. I always use the example of search engines when the internet started. Like there was a ton of there was a ton of search engines, and now we basically use one. There are others, but we basically use one. So I don't know. China ETF. We usually stay away from that for a lot of various reasons. But gold, I'm not against precious metals, but I don't think it needs to be a large portion of your portfolio. And then you have Bitcoin, again, Wild West. So just it's buyer beware on this one. This could prove to be the best one that we're going to talk about, but it's risky.
Yeah, definitely risky. All right, here's our last one 75% equities, conservative bonds, tech, AI, industrials, healthcare, financials, and staples. So, again, maybe a little less risky, but still heavy on the equity side.
Yeah, I like it. Especially again, we use the age demographic of late 40s. So in general, I like what Dennis says here with his kind of breakdown. And yeah, I mean AI does need to be a part of it because it's not going anywhere. But more maybe more AI ETF type things. But yeah, healthcare, financial, staples. I like it. I think it's a pretty good portfolio.
All right, so let's dive into the age factor here because with this prompt, it was all about somebody in their late 40s. So, a spot where someone might be a little bit more aggressive potentially, but take us through maybe how your answer and, maybe how your feedback and your approach would change for someone in their 40s, 50s, 60s, and 70s. Just kind of take me through how that changes and shifts as you get a little closer to retirement.
Yeah, kind of like I mentioned with the late 40s, I would get this money plugged in and be fairly risky with it because again, we're talking about life, not just working life. In your 50s, depending on your financial situation and your needs in this hypothetical that we're talking about, you need to be a little bit more risk aware. I would. Obviously, there's a big difference between 50 and 59 from an age standpoint and working life standpoint. Some people are getting really close to the end of their working life at 59. So that's something you need to be aware of. So I'm a big fan again of probably using some fixed income, which I know is not hugely appealing, but fixed income and bonds, they do serve a purpose. And dollar cost averaging, going back to Stephanie's point, the advisor, about maybe trickling this money in a little bit at a time. So something to be aware of. But again, fixed income, it does serve a purpose when it comes to that. Is it probably going to generate the long term rates of return that the equities do? Historically speaking, it has not. But it does serve a purpose when you're drawing down income when you do get to retirement. 60s, again, you're really transitioning. Probably, again, I'm stereotyping, but you're transitioning into that working life and non-working life anymore. So this money needs to generate that paycheck, which it didn't before. So how are we going to split that portfolio up in income producing investments as far as equity? You still want equity exposure to the stock market, but maybe not quite as heavy. And again, that dollar cost averaging, maybe we're drawing that out over, the next year or 2 years with this $1 million, depending on when you get that money. And then 70s and beyond, you're in a little more preservation mode. So your equity exposure is probably going to be a good bit less. So some of these concepts aren't, not earth shattering information is probably pretty obvious, but you really want to look at tax. We always want to look at tax strategies. So going back to this example of $1 million in after tax money, well, again, this is where you want to think, okay, it's not only what you own, it's what types of accounts you own them in. So maybe if you're really looking at a full financial plan on this person, they talked about 300,000 in retirement account. Well, maybe that's where more of your fixed income is, because fixed income is taxed at ordinary income anyways, even if it's in an IRA or if it's in an after-tax account. So maybe if you have stock market exposure, it needs to be in that $1 million account of after-tax, because that's more tax favorable if you leave it in longer than a year. So a lot of different things to think about, especially in your 70s. Again, preservation, you start having healthcare costs that you need to be really, really aware of that. And then, estate planning. What does this look like from a legacy standpoint? So a lot of things to consider, and just different age demographics. You kind of have different concerns as you go through and you age up.
Well, I think, obviously this is a kind of a good article to just get some things, get you thinking a little bit, get some discussions going in terms of where your investments maybe should be focused right now. But I think more importantly, Ryan, when you talk about, working across, the entire plan that you're trying to put together for someone, there's a lot more that goes into the discussion besides, hey, where should I put my money, right? What are some of the other things you're going to talk about with a client when you're trying to work through, a situation like this?
Yeah, I mean, a good comprehensive advisor is going to take, we mentioned tax on here a lot. Tax planning is going to be a big, big, big component of it. Estate planning is a huge component of it. And we offer that as well from both those standpoints. So yeah, it's not about just the investments. It's also, what debts do you still have? How much you need to keep liquid? How much do you have in an emergency fund? I'm a big proponent of a year's worth of income in retirement in an emergency fund, just because of stock market sequence of returns, market pullbacks. It's good to have a chunk of money sitting there that, may not be keeping up with inflation. It may be lagging behind inflation, but I'm okay with that because of the sequence of returns risk is a real thing. So if you retire and there's a big pullback, where do those funds and that income come from? And always behavior. I mean, the psychology of this stuff is always hugely, hugely important. And I think that's where maybe in some instances an advisor can offer the most value, is the behavior standpoint and the psychology standpoint of this money. We feel we put a lot of pride in that, and being educators and coaches and teachers along the way. So I think sometimes that goes unnoticed, where we really educate people and guide them through some of these maybe great moments in their life, but also some tragic moments in their life. So I think that's where having someone in your corner can really help out.
Yeah, no question about it. And you can get in touch with Ryan, speakwithryan.com to get on the calendar there. Black Oak Asset Management, all the contact information is in the show description as well. But I know it is interesting to hear what the pros recommend, but the reality of the situation is that every $1 million plan is going to be unique. As we've talked about today, a lot of different factors go into that as well. So you got to make sure you're working with a professional that's going to have that comprehensive approach to planning, which is what Black Oak Asset Management does. Again, if you want to see what those suggestions are in that article, it'll be in the show description as well. But kind of an interesting scenario to work through and case study here, Ryan. So thanks for taking us through that, and appreciate your insight.
Absolutely.